All right, let's jump right into this explainer. Today, we're tearing down the financial health of Johnson Controls International, or JCI for short. We're going to take a mountain of raw, complex financial data and turn it into a clear diagnostic check. If you want to know exactly what is happening beneath the surface of this massive industrial giant, you are in the exact right place. Let's get to work.
So, we're dealing with an absolute behemoth here. $87 billion. That is JCI's current market cap. When you're dealing with a company of this sheer size, the financial crosscurrents get incredibly complicated. It's not just a simple question of whether the company makes money anymore. It's about how efficiently it operates at this insane scale and ultimately what price the market is demanding for a piece of it.
And right out of the gate, we hit this fascinating contradiction. The stock is up nearly 20% this year alone. Momentum is absolutely rolling in their favor. But the underlying valuation data, it's practically screaming danger. So what exactly is the data seeing that the broader market might be completely ignoring?
Here is the game plan for today's explainer. We're going to start by asking, is the price right? Then we'll measure their growth engine, do a quick checkup on their financial health and dividends, and finally, deliver the final data verdict.
Starting with Section 1, is the price right? We're going to analyze JCI's valuation multiples to see how they stack up.
These multiples really highlight the massive premium you're paying today. Sure, the price-to-earnings ratio is sitting at 25.6, which is actually down a bit, about 6% from its 5-year average. But then look at the rest. Price-to-sales is at 3.56, and price-to-book is up to a whopping 6.46. Both of those metrics are elevated by more than 40% compared to their historical averages. You are paying top dollar for JCI's assets and revenue right now.
Which brings us to this, frankly, shocking number. A negative 158.53% margin of safety based on free cash flows. Usually, you want a nice, positive cushion, a safety net, in case the company's future cash flows don't perfectly materialize. But a deeply negative margin like this, it implies the stock isn't just priced for perfection, it's priced for a massive fundamental expansion that just isn't there yet.
To really put that into perspective, listen to the gap between these two numbers. The stock is trading up around $143 today. But if we run a strict discounted cash flow model, purely valuing the actual cash the business is generating, fair value is way down at $55.34. I mean, that is a massive chasm between market hype and mathematical cash generation.
So why is the market completely ignoring that and paying such a premium? Let's move to Section 2. Measuring the growth engine, where we'll compare profitability against cash flow.
Well, here is your absolute star player, a massive 26.12% return on equity. That means for every single dollar of equity JCI has, it is spitting out over 26 cents in pure profit. What's even wilder is that this completely crushes their 3-year average of 15%. They are becoming ruthlessly efficient at generating returns.
And you can literally see that efficiency trickling right down to the bottom line. Net income growth is accelerating incredibly fast. Over 5 years, you're looking at a 27% compound annual growth rate. Zoom into 3 years, it jumps to 36%. And trailing 12 months, it's skyrocketing at almost 41%. It is this beautiful compounding staircase of profit that explains exactly why the market loves this stock so much.
But, every shiny financial report has a dark spot. And for JCI right now, that is free cash flow. Remember, net income is basically just an accounting metric. Free cash flow is the real, tangible money left over after the bills are paid. It's the absolute lifeblood for things like dividend payments and share buybacks. And oh boy, does it paint a totally different picture. While net income was flying high, free cash flow is essentially tanking. The 5-year rate is a negative 15%. The 3-year is basically flat. But look at the trailing 12 months. It has plummeted by over 62%. Talk about a nosedive.
So we have to ask the obvious question here. Why on earth is net income surging while free cash flow plummets? This massive disconnect forces us to question the actual quality of those earnings. It usually points to things like aggressive capital expenditures or rising inventory costs. Whatever it is, it tells us that right now, JCI's killer profits are just not converting into cash.
But hey, before we write the valuation off entirely based on that cash flow drop, we've got to look at the safety net. If things get bumpy, does this $87 billion company have the structural foundation to weather the storm?
Which brings us to Section 3, financial health, and dividends. Let's check the floorboards to see how solid the balance sheet and those dividend payouts actually are.
Okay, so the foundation is solid, but it's definitely lean. The current ratio sits just above 1. The quick ratio is a little tighter at 0.85. But the good news, their long-term leverage is in a really comfortable spot. A debt-to-equity ratio of 0.70 means management isn't going crazy over-leveraging the company with debt just to keep operations running.
And that steady foundation has absolutely rewarded long-term holders. Look at these compounding total returns. If you held for 10 years, you'd be looking at over a 327% return. Even stretching back 20 years gets you near 290%. They clearly have a proven track record of building serious wealth over the long haul.
A huge piece of that wealth building is the dividend. Now, the yield is modest, sitting at 1.12%, but it comes with a super reliable 8% growth rate over the last 5 years. Here's the catch, though. Remember that weak cash flow we just looked at? It's pushing their free cash flow payout ratio to a dangerously high 87%. Almost all the cash they generate is walking right out the door just to maintain that dividend. There's almost zero margin for error.
All right, let's pull all of these diagnostic metrics together for Section 4, the final data verdict.
We've got a classic heavyweight fight playing out in the data here. In the bull corner, you have accelerating net income growth and an absolutely stellar 26% return on equity. But in the bear corner, a terrifying negative 158% margin of safety and free cash flow that just fell off a cliff.
If we strip away all the noise and boil this entire data dump down to one single takeaway, it's this. JCI is a historically high-priced stock supported by strong net income but very weak cash flow. The market is completely trusting the accounting profits and ignoring the current lack of actual cash generation. So I'm going to leave you with this provocative thought as we wrap up. Based on this diagnostic check, are you comfortable paying a historic premium for accounting growth when the real cash flow isn't following suit? It's a massive valuation puzzle, and digging into numbers exactly like these is what makes you a sharper investor. Thanks for hanging out with me for this explainer, and remember to always keep questioning the data.